Okay, let's dive right into this explainer. Today we're unpacking a really fascinating, honestly kind of bizarre economic phenomenon. It's called the golden handcuffs effect, and it completely explains why the global bond market is practically freezing housing mobility across the country. If you've been watching the housing market lately or, actively trying to buy a house, you know things feel incredibly strained. Instead of the usual natural ebb and flow of people buying and selling, we are looking at a market that has essentially seized up. So to figure out how we got here, we're going to unpack the exact financial mechanics driving this gridlock and look way past the surface level headlines.
We're actually looking at a massive paradox right now. On one hand, borrowing costs are sky high, which has led to demonstrably weak buyer demand. Mortgage applications are way down, and open houses are pretty much ghost towns. But normally, standard market dynamics dictate that when demand drops, inventory piles up, right? High prices usually cure high prices through a flood of new supply. Not this time. Instead, available houses are incredibly scarce. Demand is clearly depressed, but supply isn't rising to meet it. It's a complete stalemate.
Which brings us to the ultimate mystery we're unraveling today. If nobody's buying, where did all the houses actually go? It's not like homes just vanish into thin air. Entire neighborhoods haven't just packed up and disappeared. Usually in a downturn, you'd expect to see a surge of listings from people needing to downsize or relocate. So there has to be a structural, underlying reason why inventory is shockingly low across the board, completely insulating the whole market from a normal correction. To solve this mystery, we've got to look at the main culprit. Economists call it the lock-in effect. Basically, homeowners are entirely stuck. They are choosing to just sit tight and not sell, specifically to protect the ultra-low mortgage rates they secured during previous economic conditions. Think about it from a purely financial perspective. Trading a deeply discounted monthly payment for today's prevailing rates just to move across town, it makes zero fiscal sense. Even if a family desperately wants a larger home, the sheer math of taking on a new mortgage at a significantly higher rate completely kills the benefit of the move. And the sheer scale of this trap is absolutely wild. Listen to this. A staggering 70% of all current homeowners are holding on to mortgages with rates below 5%. 70%! When nearly 3/4 of the entire market is walking around wearing these golden handcuffs, the financial penalty for moving becomes an insurmountable wall. It's practically paralyzing new listings. We're seeing this synthetic shortage, where organic life events that usually prompt a move, like having kids or getting a new job, are just delayed or ignored entirely to preserve that cheap debt. So what's actually sustaining these elevated rates and keeping everyone paralyzed? Well, it's a super common oversimplification to assume the Federal Reserve is directly pulling the levers and dictating your retail mortgage rate. But honestly, that is a total myth. While Fed policy undeniably sets the baseline temperature for the broader economy, they are not the ones directly pricing out your local 30-year fixed mortgage. Assuming the central bank is just a direct dial for housing costs totally misses the complex, market-driven reality of how this stuff is actually funded. The real puppet master here is the 10-year Treasury yield. See, the average lifespan of a mortgage often aligns with a 10-year timeline before a home is either sold or refinanced. Because of that, the open market trades mortgage-backed securities based on a spread over this specific 10-year government bond. That spread, which is entirely driven by investor appetite and perceived risk, is the actual hidden math driving what you pay every single month. The quote you get from your local bank is intrinsically tethered to the performance of these bonds on the open market. It creates this incredibly complex, interconnected web of finance. Picture this. Nervous international investors and global lenders, maybe sitting on the complete opposite side of the planet, are assessing global risks like stubborn inflation, shifting geopolitics, or currency fluctuations. They adjust their demand for U.S. debt, and the 10-year Treasury yield reacts up or down in real time. And then, just like that, your local mortgage payment is calculated as a direct spread on top of that yield. It literally means your neighbor's ability to affordably sell their house is being dictated by institutional risk appetite happening far beyond your local city limits.
So bringing it all together, housing remains incredibly scarce despite cool demand because the global bond market has essentially locked up our existing inventory. You've got 70% of homeowners trapped by golden handcuffs, the 10-year Treasury holding the hidden math, and nervous global lenders actually calling the shots. Because those international lenders demand a certain yield for their capital, the resulting bond market dynamics make a lateral move financially unviable. The bond market simply won't let you move. I'll leave you with this final, provocative thought to chew on next time you're walking through your neighborhood. What happens to our society and our local economies when an entire generation of prospective buyers is priced out of homeownership by the hidden math of the global bond market? Understanding this lock-in effect fundamentally changes how we view real estate. It really highlights just how directly our local streets, our neighborhoods, and our individual life choices are tethered to the sprawling architecture of global finance. Thanks for joining me for this explainer, and keep questioning the underlying mechanics behind the world around you.